Today, let's talk about American banks, which will help you understand the American market when investing in the United States. Hello everyone, this is Brown's Wealth Management Watchtower. In fact, the banking industry in the United States is at the other extreme. American banks are purely laissez-faire, and they have gone from being extremely free and loose, tightening bit by bit and tightening bit by bit when they collapse, forming the highly securitized and market-oriented banking system we have today. When the United States first fought the War of Independence in the 18th century, although it was also a country, it was basically based on states, which was a bit like 13 states living together. Therefore, everyone printed their own money, and there was no central bank. There were only small banks in each state, and the state government did not manage them very much. The key was that anyone could issue their own bank notes, which was extremely free and chaotic. By the beginning of the 20th century, the United States had reached 20,000 banks, a staggering number. You see, there are already very many banks in the United States now, with only 5,000. At that time, the population was only a quarter of what it is now, but the number of banks was 4 times that of now, and they could all print money. In fact, before the 20th century, the United States attempted to establish 2 major banks, namely the First Bank and the Second Bank, which were a combination of a central bank and national banks. The way of thinking is very different from that of Americans, because after all, we live together, and particularly dislike the kind of large company that has a head over our heads. Therefore, both times they were established for 20 years and dissolved in the condemnation of various states until after the Civil War. You said this country has been established for over 100 years, and it has finally truly unified its currency. However, its banking industry is still in chaos, with occasional bank runs. There were 3 major bank runs in 1866, 1893, and 1907. In 1907, it was the government that finally sought financial giants, and it was only after J.P. Morgan's intervention that they united and almost the entire banking industry overcame the difficulties together. At first glance, the government realized that this was unacceptable. We can't continue like this. We can't just stare blankly every time a bank run occurs. So in 1913, the central bank, also known as the Federal Reserve, was finally established. I would say it was a minimalist summary, but in any case, it was an extreme collapse of freedom, so improvements were made. Later, in 1929, during the Great Depression, the United States experienced the largest ever bank run, and people had completely lost trust in the banking system, with approximately 9,000 banks collapsing. Do you know where the banks and the government were forced to go at that time? President Ross gave the banks a holiday to avoid a continuous bank run, and I don't think anyone will come to withdraw money. After the Great Depression, improvements were made and the Federal Deposit Insurance Corporation was established to provide insurance for all depositors' deposits up to 250,000 yuan. Now that everyone has insurance, don't run on them casually. Throughout the 20th century, the banking industry in the United States has been in a very relaxed regulatory environment, developing a very mature securities market. You think Wall Street has been trading since 1792, so you don't have to look for banks to borrow money. You can also borrow from the market, such as issuing bonds, stocks, etc. Later, it gave rise to a huge derivatives market. For example, if mortgage loans are a large market, then the United States has Fannie Mae and Freddie Mac, which package these mortgages into bonds and issue them in the secondary market. We certainly know that this marketization brought huge risks later on, but it also has its benefits, as it allows the money to quickly penetrate into the corners of the United States with the highest return rate. In fact, it's not just limited to the United States. Using Wall Street as a synonym, these American bank capital can be said to have swept through the corners of the world that can generate high returns. When you see no potential high returns, this capital quickly passes by, and the market may quickly develop. The ability to allocate capital in this way may seem normal to us now, but in the early days, most countries could not be so flexible by simply relying on banks to lend. Later on, everyone became familiar with what happened. The 2008 subprime mortgage crisis can be roughly summarized as the excessive lending of the financial system, the risk control of excessive and low leverage, and other factors. What should we do next? Just a new wave of tightening. The US government has introduced the Dodd-Frank Act, which includes Basel III agreements among various central banks. It seems to be very strict regulation of large banks, controlling their risk volume, business scope, and so on. For example, you can no longer use this money for proprietary trading, so you can honestly act as an intermediary for me. But there is a loophole here: not all banks need to be subject to such strict regulation. Only large banks with assets of over 50 billion yuan need to be regulated. Under the lobbying of many small banks, in 2018, Trump signed a bill that raised the upper limit from 50 billion yuan to 250 billion yuan, allowing a large number of American banks to escape this strict stress test. And these evaded banks include Silicon Valley Bank, First Republic Bank, and Signature Bank. This time the bank collapsed. The US government has learned to be clever. After all, people have gone through so many bank runs in the 19th and 20th centuries, and we have summarized the experience that when encountering such situations, the speed must be fast, the strength must be sufficient, and we must spare no effort to stabilize our confidence first. You see, this year the FDIC's processing speed is simply faster than Bolt's. It had an incident on Friday, took over on Monday, and even made an exception by protecting all depositors' deposits. The First Republic Bank also did not hesitate and immediately called on major banks to buy it. In the end, all the debts were wiped clean, leaving only assets and washed clean. It was acquired by JP Chase for its value. In fact, this acquisition violates the Dodd-Frank Act. As early as 2008, everyone had already agreed that no bank deposit could exceed 1/10 of the total national deposit. After the acquisition, JP Chase already had 17.6% of the country's savings, but in times of urgency, it could not afford that much. Even Switzerland made an exception and allowed UBS to acquire Credit Suisse. These urgent rescue actions were all aimed at quickly solving the current problems, such as monopolies and excessive guarantees, which can be set aside for now. It is estimated that after this incident, the United States will have to study how to tighten again in a new round. Japan actually has its own characteristics. It is not a consortium, so basically there is a huge bank around the center of this consortium, and then it comes to inject blood into the companies within this consortium. In short, different countries have their own methods to regulate banks and control the entire economy. The United States is loose and tight, market-oriented. That's all for this issue. If you have any questions, you can communicate in the comment section. If you are struggling with investment and financial management in your daily life, you can follow me with your fingers and give you different perspectives to plan your investment and financial management, making your life more comfortable. See you in the next issue.